All right, so today Dr. Eugene Cantor is giving his first webinar for the Rebooted series, discussing the topic of rethinking the nature of accounting and its relevance to business. And we're really lucky to have Dr. Eugene Cantor today as our speaker. He's gifted in many, many ways. I'll just give you a very brief shortcut of his accolades. So in addition to his teaching at Maryland and holding a Maryland CPA license, he's also served 25 years as an attorney with the Office of the Comptroller of the Currency and Office of the United States Treasury Department. So he also has a law degree. And so we're really grateful that he could be with us today. He also has served various different roles, including an investigative auditor for the government and general counsel for a private corporation. At the University of Maryland, he teaches courses in taxation and financial and managerial accounting and has received numerous recognition for his excellence in teaching. So again, thank you, Eugene, for being here today. My name is Nicole Kim. I'm a doctoral student at the University of Maryland, and I'll today help moderate any questions that our participants may have for Eugene today. So we ask you to stay muted throughout the webinars, but if you have any questions at all, we welcome them through the chat or the Q&A functions. I'll monitor them and I'll try to deliver them to Eugene, and we'll try to have a discussion going. All right, so now without further ado, I'll hand over the floor to Eugene.
Great, thanks so much, Nicole. I really appreciate it. And I appreciate all of you coming to this webinar, first of 3 that we're going to do in accounting. I would imagine that you probably had to let everybody know that you'd be unavailable between 3 and 4:30. They might have asked you, what were you doing? And you told them you were going to an accounting seminar, and they probably looked at you with eyes of envy. I can't even imagine what they must have felt, how lucky you were. So it's great having you here. What I wanted to start out with is just give you a brief overview of what we're going to be covering in our 3 webinars, including today. Today, we're going to just talk about the fundamentals of financial accounting. Generally, I've incorporated some COVID-19 issues, but they generally don't extend to the financial accounting area other than from a disclosure standpoint that they should be disclosed in the financial statements if there's any issues that are raised specifically to your business. But what I want to do is take a very fundamental approach to give you a background in financial accounting and deal specifically with the accounting conceptual framework that was designed to present information that investors and creditors, the primary users of financial statements, would want to know when making decisions about investing or providing credit to a company. We'll discuss the accounting equation, which is the basis on which we keep track of our business transactions and then incorporate them in the 4 financial statements. We'll briefly review the 4 financial statements that comprise the conceptual framework of accounting: the income statement, the retained earnings statement or capital statement if you're not a corporation, the balance sheet, the cash flow statement. And then I'd like to go through some of the fundamental concepts of the accrual accounting method, recognizing some of you are probably on the cash method, but many banks, for example, may insist on accrual-based financial statements. And accrual is a better measure of your income, balance sheet, assets, liabilities, and equity amounts. And so from that perspective, it's good to understand how the accrual method of accounting works, though admittedly the smaller companies generally do put their accounting on a cash basis. And again, banks may well require accrual-based statements. The next module that we'll cover in a couple of weeks, we'll run through the cash flow statement and the financial and do some financial statement analysis where you can utilize ratios to measure the various indicators of how your business is functioning, dealing specifically with debt paying ability, profitability, and then limitations on, we'll discuss the limitations of financial statement analysis as well. And we'll also cover a reconciliation of cash flow with the accrual-based income that you get from accrual accounting. And that is a very good way to see the differences that accrual method accounting would present versus the cash method for your business. And then the third module will deal with managerial accounting, which deals with actually using accounting concepts to operate your business. And we'll talk about some PPP tax issues in the event you might have had loans through the program. We'll specifically review how to prepare a master and flexible budget And many banks will look at budget submissions and then they'll look at variances between the budget and the actual performance. So we'll look at how we account for those various items. And then again, tax issues associated with PPP loan forgiveness and payroll tax issues. So that's just an overview of where we're going. And we've got some documents that were sent to you that we're going to deal with. And so the first one is this document here, which is actually a little workbook that I prepared for today's program. And we're going to actually run through some accounting transactions and actually prepare our own set of financial statements. I want to just mention a brief story of why I've structured the seminar this way. When I was a student at the University of Maryland getting my accounting degree, I had always wanted to be an accountant ever since I was in high school. And so I was doing pretty well in my classes, and I took my first accounting course, and I went and took my first examination, and I failed it. And then I took my second accounting examination, and I failed that. And I thought to myself, I understand, I'm doing well and everything else, I'm having problems in accounting. So I went to a fraternity brother, and I said, you know, this is what's happening. I think I want to be an accountant, but I'm having some difficulty for some reason. He said to me, well, Gene, how are you preparing for class? And I said, well, I'm going to class and I watch the professor work the homework problems, and professor will talk about the financial statements and all, and then I go take the test and I don't know what I'm doing. He said, well, are you working the homework problems? And I said, well, I really don't have time for that. You know, I was a college student, I have lots of other things to do, you know, like go out and party. And so he said, Eugene, you got to work the problems. If you don't work the problems, you're never really going to understand accounting. So I've oriented, and by the way, once I took his advice, I was perfectly fine. So I've always oriented my teaching around actually going in and working the problems to try to understand what's going on. So that's what we're going to do a little bit of practice with today. So the first question you might be asking yourself is, you know, do I really need to learn accounting as a business owner? How important is accounting? And it's a question that I get from MBA students that I have. I also teach in our business minor program, and they ask me, why is it that accounting is required? The MBA students have to take 2 accounting classes, one in financial and one in managerial accounting. So I don't know if you've heard of Scott Adams. Scott Adams is a comic, draws a comic book, a comic strip, a very famous comic strip called Gilbert. And he has constructed a concept called the talent stack. And I'd like to show you that talent stack that he's designed. Let me just pull up the, whoops, I think I've got a link I want to get to, but I think the fact that I colored this in probably messed this up. Let's see if I can still get it. If not, I'll just describe you what it is, and I'll make sure that you get the appropriate link. But let's see if I can, that was the problem. Yeah, for some reason the link is not working. So I'll just mention basically what a talent stack is. It's a series of specific goals that you want to have for learning particular skills. And what he says with the talent stack is you don't have to be particularly good at any one talent, but if you stack together a series of talents, it will have the effect of magnifying your operations, your ability really to conduct business or whatever your profession is. And he lists a talent stack specifically for, the talent stack is specifically for business owners. And listed as number 1 is accounting, an understanding of accounting. So I'll just mention that, and again, I'll make sure that I get you the link for that. And here's an example of one of his comic strips. You might say, well, do I really want to take advice from someone who draws comic strips? I'll just mention that he does have an MBA from Berkeley, and he's worth somewhere in the neighborhood of $75 million. It's been incredibly successful with many business ventures that he's entered into. So again, I'll get you that, and it has a very interesting explanation from him on it, and I recommend that you take a look at it. Okay, so let's move now to the accounting conceptual framework, which the accounting profession had to design initially to try to determine how it would provide the accounting information or financial information that creditors and investors would need in order to determine whether they wanted to loan money or invest in a particular company. And this is the basis for the 4 financial statements that the profession came up with. you can see that they are broken down into two basic fundamental qualities: qualities of accounting information and then faithful representation. So the qualities, the key word here being qualities, okay, of accounting information, and then here, faithful representation. So the information investors and creditors should get needs to have certain qualities, and those qualities are relevance. It has to be relevant to the decision-making they want to make, i.e., do we want to invest or loan money to a company? Confirmatory value, which means we can use the information to confirm what it was that we decided. In other words, was it a good idea to invest or lend to this company? And then finally, materiality, which means that the financial statements or information has to disclose to what we would consider a prudent investor or creditor. It's more of an objective standard, what they would want to know in making the decision. So materiality essentially says that if the dollar amount involved, a particular item, is so small the investor or creditor wouldn't care, we wouldn't necessarily worry about it from a financial accounting perspective. But if it would be important to a prudent investor or creditor, then we would consider it material and we want to have it in the financial statements. A good example of this is when Steve Jobs was terminally ill with respect to Apple. It was not that his illness was not disclosed, and there were lawsuits filed against Apple for not disclosing that important fact, given how instrumental what Jobs was to Apple. Investors felt they should have known that before investing. Of course, they don't have any regrets, I guess, about buying Apple stock at this point. Okay, and we also have faithful representation, which simply means that the information needs to be complete. So all the assets, liabilities, equity, income, expenses have to be disclosed. The information should be neutral, meaning it's not biased by the entity providing the information, and that reasonable people would agree on what the information represents. And it should be free from error. Now, this doesn't mean that there's no tolerance for error, and this is a misimpression a lot of people have about accounting. Accounting is not necessarily perfectly accurate. In fact, you'll see if you look at the larger companies, the big public companies, they generally round their information to the nearest millionth, which is not anywhere near as accurate that we would consider what accurate is from a NASA standpoint, for example, with a space flight, where if they're off by a second, they can wind up missing their target. So free from error really means that you're using the appropriate accounting principles to structure your financial statements. Okay, we'll talk in a minute about the 4 financial statements that we're going to review, but first let's just take a brief look at business activities and how those are divided. And this is for purposes of our cash flow statement that we'll look at. Businesses basically conduct 3 types of activities: financing activities, where they're borrowing, issuing stock, or issuing bonds; investment activities, where they're purchasing long-term assets like plant, property, and equipment; and then operating activities, where they're receiving revenue from business activities and incurring expenses to operate. So you'll see on the cash flow statement, we're going to break down those activities to show the cash flows among those 3 activities. Let's talk briefly about the financial statements, the 4 financial statements. We have the income statement, and these are the statements we felt in the accounting profession that investors and creditors would need to see to give a complete picture of the company's operations. The income statement is prepared for a period of time, a month, a week, a year, it can be any time. We call this periodicity. And it will enumerate the sources of revenues and expenses, gains and losses, net income or net loss of the enterprise. Okay, so it's for a period of time. And we're going to, for that period of time, look at revenues of the company, expenses of the company, and we're going to list material items separately. For example, salaries and expenses, rent, royalties, etc. Now, for a corporation, we have a statement of stockholders' equity. If you're not a corporation in your business, not formed as a corporation, it may well be a unincorporated entity. You wouldn't see stockholders' equity. You'd simply see a capital amount, which would represent income that's been kept in the company, plus your capital that you've invested in the company and haven't taken out. In a corporation, you have a breakdown between the capital, which is represented by common stock, and then you have retained earnings separately stated, which represents earnings that have been kept in the company. So again, for a corporation, you would have the stockholders' equity showing at a specific period of time, the corporation's changes in the stockholders' equity and its ownership, showing the initial stockholders' equity, common stock and retained earnings. There may be other classes of stock, what it began with, what the equity then was added to the equity or subtracted from the equity, whether there was income, losses, or dividends paid out, and then what you wound up with. The third type would be the balance sheet, which represents the assets, liabilities, and stockholders' equity of the company at a particular point in time, a particular date. And so you can see, make comparisons. Companies will, the investors and creditors will compare from year to year. Typically, there'll be more than 1 year given on all of these statements, and they'll make comparisons, so you'd be able to see increases and decreases in the assets, liabilities, and equity. And then finally, the statement of cash flows is necessary because the income is not necessarily representative of the cash receipts, nor are the expenses necessarily representative of the cash outflows. It's prepared for a specific period of time, summarizing the cash receipts and cash payments of the corporation. Okay, that's some general background before we actually get into preparing the financial statements and taking a look at some transactions. Let's talk about the accounting equation, which is the basis of the accounting method that we're going to use, okay? And with this, I want you to think of this as, and this, I have to say that theoretically, it's a little difficult to follow this sometimes. It's a fairly simple concept, but it's not the way we're programmed to think. And really your first year in accounting, that's basically what's done to you, is they try to reprogram you to not think along the cash method when dealing with accrual accounting. But this is a different way to think, and students I know have some difficulty sometimes with it if they're unfamiliar with it. But it's a fairly simple concept. And what we say is that we have assets, and the assets are in our company, and the purpose of an asset is to produce revenue in the future. So for example, why would a company buy a building? Well, obviously, if they want to have an office building to work in, or if they want to rent out a building, if that's their business, they need to buy a building, obviously, in order to generate either rental revenue or revenue that comes from the fact that you have office workers in that building who are working for you, helping you to generate revenue. Once an asset no longer works to generate revenue, you have to get it off of your books, okay? Now, I want you to think of this as having a little fulcrum here, so that this is really, think of it as a seesaw. The seesaw must always be level. So the assets that we own had to come from someplace. What are the places that they could have come from? We could have borrowed from a bank or from another type of entity, and we would call those liabilities. In addition, we could have investors put money into the company, purchasing, if it were a corporation or capital stock, or not a corporation, just investing in our capital, okay? And in which case we would issue, in the sense of, if it's a corporation, we would be issuing stock to the corporation, to the investors, right, from the corporation. And then finally, we can earn money, right? We can sell inventory for more than we paid for it, or render services and keep that income. That would constitute retained earnings. So the assets must always be equal to what we borrowed, represented by liabilities, what we own, which would be the owner's equity that constitutes, in a corporation, stock that we've issued and received an investment from the investors, and earnings that we have kept in the company, okay? So sometimes there's a tendency to think, well, a liability, if I owe money, shouldn't that be represented by a negative? But no, this must always balance. So what we're showing on the left side are the assets of the company. On the right side, where those assets came from. We also talk about the right side of this equation as claims on the assets. For example, when an investor buys stock in a corporation, the investor puts money into the corporation, receives the stock. If that corporation then were to liquidate, the investor would expect to try to get that the money should be returned right upon the liquidation of the corporation. Now, that may or may not be the case. If the corporation, for example, has debt, the creditors would be paid off first. And again, they would expect repayment of their loans to the corporation. And then likewise, the corporation, any money left over would go to the equity owners. So that's why we call these claims. So we'll always have a positive relationship, an equal relationship between what the assets are that are owned and then where the assets came from, where the claims of the assets are on what was borrowed and what was invested and what we earned either through rendering services or selling inventory at above our cost. Now, the concept of unexpired, yes, question?
Sorry, before we move on, if you still wanted to talk about the Talent Stack link, I can send that to you in the chat if you wanted to still cover that a little bit.
Yeah, sure. If you want to, let's see, I don't.
I just sent it in the chat.
Said, okay, the chat I see up here,
Yeah.
right?
Also, just to note,
Thanks.
in the webinar function of Zoom, we just realized that there's no breakout session. So for the workbooks, maybe we can replace that with individual.
Yeah,
okay.
that's fine.
Okay, thank you.
Sure, thanks for letting me know that. Yeah, I just thought you might be interested in this. So this is Scott Adams, and just to show you the business talent stack. So a business talent is a stack in itself because there are a lot of moving parts to be successful in it. For entrepreneurs, this talent stack is learned on the job. So number one on that list is accounting. Then you can see managing people, marketing, resourcing, negotiating, team building, sales, product development. But number one on that talent stack is accounting. If you want to learn more about it, he does have a brief video on it in this website. And you can take a look. Yeah, here it is discussing it. It's very interesting. It's got different other talent stacks as well that are listed. Thanks, Nicole. I appreciate that. Okay. Nicole, are there any questions that anyone has or anyone you want me to address at this point?
No, not yet.
Okay.
But I'm sure we'll have them coming soon.
Okay, great. Just let me know. All right. So let's move on now to the concept of unexpired cost assets and expired cost expenses. So this is where you want to think a little differently than you've again been trained to as someone who has only experienced or thought of terms of business transactions as cash transactions. Okay, and again, now this is more of a problem with students who are absolutely stuck on this. I think many of you have probably already experienced and maybe probably have some familiarity with the concept of accrual. So what we have, as you can see over here on the unexpired cost side, we have a listing of various assets: inventory, prepaid insurance, machinery, goodwill, minerals, buildings, and prepaid interest. And these will convert. Remember, I mentioned that the assets, as they expire, they will move over and become expired costs. As assets, they will be listed on the balance sheet, you can see, and then over here, as the assets expire, they'll move over to the income statement and be reflected as reductions in net income. So for example, inventory, when a purchase is made, if the purchase is made for cash, it is not expensed because it's an asset. A good example, by the way, of the way this works is I'll typically ask people, if I pull into a gas station, I put $40 worth of gas into my car, am I out $40? Am I worth $40 less because I spent $40? And 80% of them will say, well, yeah. And then I'll say, well, what about the tank full of gas, right? Isn't that $40 worth of gas? They'll say, well, you can't sell it for that. I'll say, yeah, but I'm not planning to sell it. I'm going to use it. As I use the gas, it moves from an asset to me back over to an expired cost. In this particular case, you buy the inventory. It's not an expense. The inventory stays on your books as an asset reflected on the balance sheet. And then as you sell the inventory, it moves to cost of goods sold, which has an impact on the net income of a company, right? Reducing it. And that would be reflected in the retained earnings of the company. The same with machinery. As you use machinery, well, go to prepaid insurance. You purchase 3 years worth of insurance. Do you have an expense for the 3 years? No. You have an asset, right? You've exchanged one asset for another. So again, you would list that asset, prepaid insurance, on your balance sheet. And then as time expired, reducing the amount of prepaid insurance, you would move that to insurance expense, would be reflected on the income statement, and would reduce the equity portion of your balance sheet. So always think about, again, the idea of being in balance as we set up here. So if, for example, I buy insurance and I buy it for a period of time, the cash, let's say I pay cash for it, well, cash would go down, but then I have an asset, right? Insurance would go up by an equal amount. But then as the insurance is used, the insurance would go down and it would be reflected as an expense, which would be reflected over here on retained earnings, reducing my equity. So we're always going to be in balance when we do these transactions. And therefore assets will always equal liabilities plus equity. A machinery, you purchase machinery again, that machinery is going to produce income for you over its life. So you estimate the life of that asset and you depreciate it, reducing the amount you carry on your asset side of your balance sheet. As you depreciate it, you will reflect that depreciation as an expense, reducing your equity. But initially, when you purchase the machinery, if you again purchased it for cash, say $25,000, cash would get them by 25, but then you would record an asset equal to the amount you paid for the machinery, which would be 25,000. Your equity would be unaffected. Now, goodwill is an interesting concept. Accountants do not permit goodwill to be reflected on the balance sheet if it is self-generated. So you might look at big companies and see goodwill in there, like McDonald's. For example, you'll see goodwill. Where did that goodwill come from? Well, McDonald's has lots of goodwill built up over the years, no doubt, from its many years of operations, the Happy Meals that sold, that children remember as they grow older and decide that they want to go to McDonald's. But goodwill represents what your company is worth in excess of the identifiable assets. So you might be able to gross your assets up, your net assets up to, let's say, a value of $1 million, but you would say, I'd never sell my company for just $1 million because I have ways of making, a return on my investment that's higher than, say, companies that are like me, but don't have the operations that I have to earn a higher rate of return. Well, the additional amount that might be paid for your company, say instead of $1 million, $1.2 million, that 200,000 is considered goodwill and goes on the assets of the purchaser as goes on the balance sheet as an asset. By the way, under GAAP accounting, generally accepted accounting principles, goodwill is actually not amortized, or as we mentioned, depreciation over time. Goodwill remains on the books unless it's impaired, in which case then it has to be written down. Minerals, again, you purchase minerals. What you do there is as you mine the minerals, you deplete them. So you initially have a purchase price for the minerals, and then as you mine the minerals out and sell them, you have a depletion charge that will reduce, that will be considered an expense. Buildings as well, your building goes on the balance sheet as an asset, and then you depreciate the building over its useful life. And finally, one here, if you prepay an asset similar to prepaid insurance, prepaid interest, likewise, that would go on the books as an asset and then be reflected as interest expense once the prepaid interest actually becomes accrued. You actually owe it. Okay, so what we're going to do is we're going to work through a series of transactions just to give you a feel for how accounting works. And you should treat this really as a game, as rules of a game. We already understand the basic concept of, if you look down here at the accounting equation, we have the assets went over here equal the liabilities plus the stockholders' equity. So again, if we have an asset on our books, it had to come from liabilities, issuing common stock, or retained earnings, meaning earning some money either through selling an asset for more than we paid for it, such as inventory, or rendering services. Now, you'll notice that we're going to keep track of our income statement over here. Revenues minus expense equals net income. And then we'll also keep track of our cash flows over here. So you'll see the cash flow will not always be representative of the amount of the expense, of what an expense is, okay? In other words, expenses or revenues will differ from actual cash inflows and outflows. So here are the rules of the game and some terminology, okay? First off,
Oh,
we
sorry.
have question.
Yeah, just a quick question. So Lewis asks regarding the goodwill and intellectual property, how would intellectual property be impaired over time? And he's asking if it's maybe close to expiration that this happens.
Yeah. Well, I can think of one example. I don't know how many of you have heard of Jack in the Box. It's a West Coast fast food chain that's been around for many years, and they had goodwill. I think they had made some purchases of companies that, of similar fast food restaurants, and they recorded they paid more because of that extra earning capacity. And then one day they wound up, there was something wrong with their machinery, and a number of people got food poisoning. And all of a sudden, Jack in the Box wasn't so popular anymore. So as a result, the goodwill would be written down because of the fact that, unfortunately, because of that unfortunate event, it just really wasn't evidenced on the books. Now, how do you measure it? What you do is typically you look at the value of the assets of the company on a gross basis. So say it's $1 million. And then you go ahead and you figure out what the value is of all the identifiable assets of your company. And maybe that's 900,000. The extra $100,000 would be representative of goodwill. Finance professionals can actually calculate the value of goodwill. What they'll do is they might say, well, your company is able to get a return on investment of maybe 18%. And similarly, place companies in your particular business get a 2% less typical return. So that 2% would then be capitalized, and that's how you would actually value the goodwill. But an impairment would take place, again, if all of a sudden, for whatever reason, your return starts to drop, and it's attributable to something that has impaired your goodwill. The goodwill really represents the capitalized value of that extra earnings you're able to gain. Maybe your employees are particularly good. You've assembled a very good set of employees, or you have some secret formula or something that you're using, something that's not, that other companies don't have, that gives you that extra earning capacity. And that's a value. Many entrepreneurs that I've had in my classes have said, I'll always ask them, what do you think the value of your company is, and what do you think the value of your assets are? And they would always say, well, my assets are this amount, but I would never sell my company for that. And they'd say, because my company has the ability to earn more than what other companies in my situation are able to earn. So yeah, your test for impairment, again, is to simply look and see, are you still maintaining that upper level of that extra earning capacity? And if not, then the asset has to be written down. Okay, so let's just look here at the rules of our game. We've got U.S. generally accepted accounting principles. You've probably heard this term, otherwise known as GAAP. So that's what we use in accrual statements. And these are principles generally accepted in the United States. Revenue recognition. So this is what's going to be different. We're going to recognize revenue not when we receive it, but rather when we've earned it. Now, when have we earned revenue? We've earned revenue either when we've performed services, or we have, and we expect payment. There's a general expectation that you're expecting to get paid, but the money is owned. So you've either performed services or you have delivered products to the customer. So effectively, you've performed what you were supposed to perform in terms of earning that revenue. Well, that's when you earn it. This is one of the two areas, again, where you have to sort of rethink. I'll have students, for example, I will say to them, they're working a job. I might say, okay, so you've worked for 2 weeks. Have you gotten any money your first 2 weeks? And the student will say no. And I'll say, okay, have you earned anything? And they'll say no. I'll say, okay, so if they don't pay you, then you'll be okay with that. And they say, well, no, I've earned it. When you earn it, that's when you record it, okay, as earnings, not when it's paid. So you can see right there, there'll be a difference between the cash flow and the earnings if you're not paid at the time you've actually earned, if you're paid later. The expense recognition, the same idea. recognized not when incurred, recognized when incurred, not when paid. So a good example there is, again, purchasing a building, purchasing a machine. You might buy those items, but as you use them over their life, we spread the expense as the machine is used, or as the building is used, or as the prepaid insurance is used. So again, the two keys here that are a difference between cash accounting and accrual accounting is that revenue is recognized when it's earned, services are rendered, products are delivered, and expenses are recognized when they are incurred. We've had, rent that we owe now. We've been here a month, so we now owe the rent. That's an expense. Haven't paid it yet, and that's got to be reflected on the income statement, though, that you actually have an expense on your that you have to recognize, not when the item is paid.
Eugene?
Yeah.
Related to that point, we just received a question. Tatiana is asking, does the revenue recognition principle also apply to nonprofits?
Nonprofits are sort of a different type of accounting. The concept would be basically the same as far as if they have revenue, they're rendering services and the like. Yes, as far as I know, I'm not an expert in nonprofits, but as a general rule, if nonprofits are accounting for revenue, I believe that they would still use that concept of accrual accounting and recognizing the revenue when it's earned. That's something I can check into and let you know for sure on the in the next module. But I believe that would be the case. Okay, and so the idea here is this concept of matching. You can see what we're trying to do is to match the revenue with the expense that was incurred to generate the revenue. So again, the asset is only purchased in order to generate revenue. That's the whole purpose of purchasing an asset. And as the asset is used, we are going to match the cost of that asset over the revenue that it is generating for us. And again, if an asset ever becomes impaired in the sense that it will not generate revenue for you, it has to be written off of your books. So a good example of that would be inventory that suddenly is rendered obsolete and you can't sell it. That would then have to be written off as a loss on your books. I mentioned the full disclosure principle. So all material information that a prudent investor or creditor would need to make for an informed decision has to be disclosed on the financial statements. So all the liabilities would have to be listed, unless very immaterial. Typically all liabilities would be listed. Anything that is important to the company, if you look at company financial statements, you'll typically see on their books footnotes that will also describe in greater detail beyond the particular financial statements. Okay, just a little bit more on terminology now. You'll see in some of the problems on account. What does on account mean? It means that the transaction occurred without the exchange of cash. So for example, if you render services for someone and you're going to charge them for those services, but they're not going to pay you yet, you would record the revenue. So you can see, if you look up here, when you record the revenue, you're going to see that the income will be earned, and as a result, retained earnings would go up on the equity side. But over here, you don't have any cash to put in. So what do you put in? We use accounts receivable. Okay. Which you no doubt have heard of, accounts receivable. And so accounts receivable would go up. You'll see the income would go up, and that would result in the retained earnings going up. So we would be in balance. Same with an account payable. If you go to the hardware store and purchase supplies for your company, but you owe them the money, you haven't actually paid for it yet, that would also be likewise considered an account payable. So you would show the liability, you'd record the asset, and you'd record the liability for the payment. So that's what on account means when you see it in the problem. Okay. Now, accrual, I've mentioned I have a separate worksheet that we'll talk about after we work through this worksheet, just to explain the concepts of accrual. And accrual means it's a revenue or expense that's recognized before receipt or payment. So again, I just gave you an example of an accrual. We recognize the revenue from a sale, even though the customer isn't paying us yet, we've earned it. So we're going to recognize an account receivable as an asset that the money is owed to us, and we record the revenue. That's called an accrual. And then later when we collect the money, all we do is reduce our account receivable and increase our cash. So the only effect is on the asset side of the transaction. And I'll get into that in more detail. Deferral works the other way, where we have a cash receipt or payment that occurs first before we recognize the expense or revenue. A good example of that is the prepaid insurance example that I gave, where I said you buy 3 years worth of insurance, you've paid for it, right? You might think, well, I have an expense, don't I? Well, no, you've bought an asset. You've basically exchanged one asset for another. So the payment comes first, and we defer recognition of the expense until the asset is used. An account is basically a bucket for showing additions and subtractions to an asset, liability, equity, revenue, or expense. So cash, for example, we'll keep track of all of our cash transactions and pluses and minuses. And then at the end of the day, we'll add it up and we'll see what our cash balance is. So an account is just going to keep track of assets, liability, equity, revenue, and expense balances. Now, I can't let you go without mentioning debit and credit. Okay, now this is not, from our perspective, because we don't have a lot of time in the modules, this is not a concept that you need to have to understand financial statements. It's really more of a bookkeeping issue, but everyone, I can't let you have an accounting discussion without at least mentioning what this is, because the first thing someone will say to you is, well, I don't know what they taught you, because you should know what a debit or credit is, right? So if you think of your checking account, the way you probably keep track of your checking account balance, you have one column that you use. And so when you make a deposit, you take your pre-existing balance, you add the deposit to it, figure out what your new balance is. Then when you have an expenditure, you go ahead and you subtract, figure out your new balance. Well, accountants use what's called double entry bookkeeping. And what this is, it's designed to give us a check, and accountants always use all kinds of checks and balances. You're seeing one already, right? Assets must always equal liabilities and equity. If they're ever out of equilibrium, we know there's a problem. So debits and credits, pretty simple concept. Debit means left and credit means right, okay? So left, right, left, right. Let's say this is cash. Let's say this is accounts payable over here. Debit means left, credit means right. That's all it means. I guess we use debit and credit because it sounds more professional, right? So we would say that cash, if cash goes up, let's say we receive cash from a customer, we would record that on the left side over here as a plus. If we borrow money, let's say this was actually a borrowing of money, okay? So what would happen? Well, the cash would go up. Let's say we borrow $50. And then we would have notes payable. Let's say we have a note that we owe. Now, to make it balance, liabilities go down for debits and up for credits. So the way that transaction would be booked would be we'd have a debit to cash of $50 and a credit to notes payable of $50. All right, now I know what you're thinking. You're saying, okay, so why is it that when they credit my cash account, it goes up? Because didn't you just say cash goes down for a credit? And that's right. But you've got to understand that the bank is looking at your deposit as a liability. So when they credit your account, what they're basically saying, they're adding to their liabilities what they owe you. And that would be where the credit comes from. So every transaction would be recorded as a debit and credit. But you can see, because of the fact that they flip from what, debits go positive for assets and expenses, and they go for, and credits will reduce liabilities, equity, and will increase rather liabilities, equity, and revenues. It gets pretty complicated, but that's all you really need to know. That's all debits are, left side and right side. So we're going to book all of our transactions without using debits and credits to this accounting equation, this expanded accounting equation, where we'll show everything together, okay? Assets, liabilities, equity, revenue, expense, net income, and cash flow. So since we can't break you out into groups, what I was going to suggest is let's have you work a few of these. Why don't we do the first one, and then I'll release you to spend a couple of minutes on your own to record the transactions as best you can through transaction H. Okay, so we'll go down here to H, and we'll stop there. Okay, so that's as far as we'll go. And this will just give you a feel for how the financial statements are prepared. And I think it'll give you a much better understanding then of the role each statement plays. So what would you do with the first one? The company issued $24,000 of common stock for cash. Now remember the cash flow over here, there are three categories, right? We mentioned up here. Financing, which is borrowing, issuing stock or issuing bonds, investing, purchasing long-term assets, and operating, which would be your operational activities, such as paying salaries and earning revenue, okay, and your basic expenses. So take a minute and try to figure out how this one would be done. And you can put the account up here, which I think all of you probably know is cash, right? All right, so you probably have cash down here at 24,000 on the plus side. And where did the money come from? Common stock issuance, right? 24,000. Is cash involved? Yes, it is. Cash flow would be financing, right? We're financing our operations by issuing common stock. Do we have any revenue, expense, or income? No. All we've done is issue $24,000 of stock, receive $24,000 of cash, and we've done that as a financing cash flow. We haven't earned anything yet, and so the equity represented by the stockholders at this point is $25,000. The assets, 24,000. The assets are 24,000. So we are okay because it all equals, it balances. Notice you put a positive number here rather than a negative number, though you might be thinking, well, don't they they've issued stock, so shouldn't it be negative? I hear that all the time, but no, you want it to balance. So we owe, basically we have equity from our investors of 24,000, and we've gotten cash we've taken in of 24,000. They would have a claim on those assets at this point. Okay, any questions on that one? All right, so why don't I release you to try to see what you can do? And let's do this. We'll go down to G and then try H and see if you can think of how that one would be handled. And we'll take a few minutes to do that. Yeah, I filled in the next one, B, for you. You should have cash of 10, notes payable of 10, you're in balance. And that would be a financing activity. Again, no revenue, expense, or income yet, right? Just financing our activities. So for C, you have an asset exchange transaction, right? Cash being spent in the amount of 15,000. Your rickshaws, you could put that up as a fixed asset, or rickshaws, 15,000, and the cash flow would be an investing activity. You're investing in your business. You don't need to list the amount here unless, and sometimes you'll have a transaction that implicates more than one cash flow operating activity, or rather activity, but none of these do. So you have to rewrite the number if you don't want. Should be down to D. Okay, so for D, you've earned 10,800, right? They pay you. So you're going to have revenue of 10,800. You're going to have income, 10,800. And retained earnings goes up 10,800, and that would be an operating cash inflow. Next, the company buys $1,500 worth of supplies on account. So hopefully you knew this was a asset exchange, right? Supplies, you bought at 1,500, and you have an account payable here, 1,500. Apologize for my handwriting. Made these a little too small. Next one, if the company provides rickshaws, or a company provides rickshaws transportation services to riders on account in the amount of $3,200. Okay, so here you have accounts receivable that you're going to book of $3,200. You're going to have retained earnings of $3,200. Revenue goes up by $3,200, and net income is $3,200 as a result. And that would be an operating cash flow. Normally, when I record this, what I'll do is just for logic reasons, you show your account receivable as the asset, and then you record the revenue as your inflow, right? You're being paid for that, or you've earned it, right? And then There's no related expense at this point. So you have your net income, and your net income would represent what your increase is to your retained earnings. So that's why I typically will do the income statement first and then flip back to the retained earnings to balance the balance sheet. Let's move on to G. One year's worth of insurance for $1,200. So here you're just making an asset exchange, right? You're paying cash of $1,200, cash goes down, your prepaid insurance goes up, nothing else happens on the right side of the equation, and that's an operating cash outflow. I should mention that the cash flows can be inflows or outflows, right? And sometimes it gets confusing when you talk about investments, but if you sell an investment, that would be considered an investing activity, the money that would come from selling that investment. But here it's just an operating cash outflow. So you should have an entry in your cash flow column every time you have a cash entry. Company received the $2,300 as an advance payment for rickshaw services. So this one I'm curious to see what you think. We can agree that the payment is for services, right? In advance. So cash, you would say, is going to go up by $2,300. Now we're out of balance, aren't we? Because we got our assets up 2,300, but nothing's happened over here. So would you record it as revenue? No, you haven't earned it yet, right? Can't record it as revenue. Well, did you issue common stock? No. You wouldn't have any retained earnings increase because you didn't record any revenue. So where do you think you would record it as? And why? Any thoughts?
One suggestion was in advances.
Yeah. And how would we characterize or classify the advance? We call it revenue received in advance, and we classify it as a liability. It's an advance payment. We haven't earned it yet. What does that mean? The logic of that is that we've been paid the money up front. So we either pay it back, right? It's a liability, or we render the services to earn it. So really, if you think of it as a liability because it's an advance payment, you haven't earned it yet, the way you pay it back is to either earn it by rendering the services or delivering the product or paying the money back. So that's why it's characterized as a liability. Good, that's very good. Now, the next entries are a little different. We call these adjusting entries. So this is really where you get into accrual accounting. They're not transactional based.
Eugene?
Yeah.
Before we move on, we did have another question from Thomas asking, at the initiation of a business loan, does the company accrue this liability for future carrying charges, which are only realized in the future years? Right.
Initiation of the business loan, you mean you're starting out your business and someone has loaned
I think so.
Loan money, and so you're paying interest on it? You would basically show the cash increase, and then you have the liability for the loan, and then as you accrue the interest, you would record that as interest expense.
So the accrual would be the interest.
Correct. Yep. And the entry here you would make would be the cash that was borrowed. You would have a note payable in that case, and the interest would only be recorded as it accrued.
Got it. Thank you.
Mm-hmm. Okay, now the adjusting entries are really where we get into the key of accounting. This is where you have to sit down and say to yourself, okay, what has occurred that require me to move off the cash method and into accrual accounting? This is really where accrual gets to be particularly interesting because you have to oftentimes anticipate things. So I've sort of given you what the key ones were, but if I were to ask you, for example, well, at the end of the year, let's say it's now the end of the year and we're going to try to figure out what has happened that might cause us to make some entries here, you might say to yourself, well, you know, we got an advance payment, so maybe we earned some of that, right? And so, yeah, you may have delivered the product or rendered the service. So you would then record the income at the end of the year, you know, before you issued your financial statements, I should really say at the end of the period. Or you might be in a building and the rent is due on an annual basis and it's the end of the year and the year's gone by, you owe the money, haven't paid it yet, but you've got to accrue that expense, right? You now owe the rent, you've got to show it. So this would be some examples of adjusting entries that would be made by the accountant. The company accrued $2,500 in salaries as an adjusting entry at the end of the year. So what we're saying there is it's the end of the year, we owe payroll, but we haven't paid it yet, but we have to show the liability on the books. So how do we do that? We're going to show a salaries payable. Okay, so we'll book salaries payable. And that would be, we owe $2,500 because the investors and creditors want to know what liabilities do you have. Well, here's one, you have payroll, but you haven't paid it yet. And it's the end of the year or end of the period. Now we're out of balance, aren't we? We have a liabilities. The right side, what's going on over here? Well, nothing. There are no assets being exchanged or anything, but we do recognize an expense, right? Of $2,500 salary expense, which would reduce the income, reduce the retained earnings, and there's no cash flow, right? That's called a salary accrual. It's an adjusting entry that's done before you prepare your financial statements. Here's another one. The company made an adjusting entry for 2 months worth of insurance on the rickshaws that had expired. So it's 2 months have gone by since they bought the insurance. Now we bought the insurance back here in G. If you go back to G, you can see, oh yeah, we bought a year's worth of insurance and they're telling us that 2 months of that has expired. We need to record it because we're producing financial statements. So by my calculation, 1,200, I think they're 12 months in a year. That's $100 a month, right? So we have to show 2 months of that insurance has expired. So let's do that over here. We're going to show we have the prepaid insurance that we recorded initially as an asset, right? When we bought the insurance. Over here, prepaid insurance. Now it's only $1,000 worth, right? So we're going to have to write the insurance down by 1,000. So we'll say, I'm sorry, by 200, prepaid insurance. We're going to reduce that by 200. Retained earnings is going to go down by 200 because we now have insurance expense, don't we? And what we'd normally do here is we would note that this is insurance expense up here to keep track of our income statement. So the net income is going to go down by 200. And again, there's no cash flow on an adjusting entry, right? Ah, here's K. We've now earned some of the rickshaw services, $1,000 worth. We've already gotten paid, so we're not going to record a receivable on that, right? We already got paid for it. So now we're going to move our liability, prepaid revenue. We're going to reduce that by $1,000 because we've earned it. We've paid it back by rendering the services. Revenue goes up by 1,000. Net income goes up by 1,000. Retained earnings goes up by 1,000. So we're in balance, right? Liability went down, but equity went up. So we're okay. Nothing happened on the left side. and no cash flow. And then we've got L. The company made an adjusting entry for supplies used after it took inventory of the supplies. It only had $700 worth. You might recall that back in entry E, we bought $1,500 worth of supplies. That means we used 800 if we only have 700 left in inventory. So we're going to reduce our supplies by 800. Retained earnings will go down by 800. Expense, and we would say here supplies, right? Income goes down by 800, and the cash flow, not applicable, right? The company declared, now this is interesting, the company declared and distributed a dividend in the amount of $1,000. A dividend is not going to appear on the income statement. It's going to be on the cash flow statement and on our equity statement, but a dividend is not an expense. Not an expense. Why? It's a distribution of earnings. Okay. So in this case, then we're going to record cash is going to go down by 1,000. So how do we make it balance? Retained earnings goes down by 1,000. We would just note up here, dividend. Cash flow. Now, interestingly, you'll see a little distinction that we make in accounting. The dividend is considered a financing activity, okay? And it's viewed as a financing activity because you don't have to pay it. You never have to pay a dividend until you declare one. But so it's viewed as not an expense, but just a distribution of a company's earnings to the shareholders. But let's go down to N. The company paid $500 of interest that accrued on the note. So we signed that note. Now the interest is accrued, we now owe it. So we're going to pay it. So cash is going to go down by 500. Retained earnings go down by 500. We have interest expense. I actually don't need to show the expenses as going down because we assume they all go down. So retained earnings goes down by 500. We have a $500 interest expense. Net income goes down by 500. And interestingly, this is viewed as an operating activity because you have to pay it. So dividends are financing for the cash flow statement, and interest is operating for the cash flow statement. Any questions on the recording of those transactions? Now we'll put our financial statements together, and I'll show you that. Any questions on this? Just gives you a feel for how all of these statements relate and their various functions once you see how the transactions are recorded. I'll make just a couple of comments. When it comes to accounts receivable, under the accrual method of accounting, what the finance people typically will do is estimate some of those receivables may not be payable, and you actually estimate the what we call the bad debt expense, to record to match the expense of the non-payment with the recording of the revenue. So you might record $1 million of revenue as an account receivable, but let's say maybe 10,000 of that you're not going to collect. You estimate that and actually record that as an expense. Depreciation also, we keep track of that. That's more detailed than you probably need, but I just mentioned there are other issues that you get into, but this is just trying to stay fairly basic. So with that, you should have, and I'll just show you this, the workbook completed here. And this will show you what we did in the production of the financial statements. All right, so each of these on the top represent your accounts: cash, receivables, supplies, etc., all the way across. Revenues and expenses, here are your cash flows. So what we would do is total these up, and you can see here's our balance sheet. cash, receivables, supplies, rickshaws or fixed assets, prepaid insurance, accounts payable, revenue received in advance, notes payable, salaries payable, common stock. Here, and retained earnings. Notice we keep track of our revenue. And every time we recorded a revenue, we have them here. 15,000 is what we earned, and then we recorded our expenses. And we have those listed here: salaries, insurance expense, supplies expense, interest expense. And here are our cash flows right here. So now we have everything we need to go ahead and prepare our financial statements. So let's do that. And I've done it here just to save time. We just record here the income statement. Revenues, 15,000. Notice we've got our expenses. Notice the dividends are not on this income statement, right? So we've got our salary expense, insurance expense, supplies expense, interest expense. We have net income of $11,000. Accrual method. This is the retained earnings statement. This is actually a fuller statement called the Statement of Stockholders' Equity. It gives a very nice indication of what happened to the entire equity side of the balance sheet. So you can see that we started out with these balances here because we were a brand new company. And then we had net income that increased our retained earnings. We had dividends that we paid. There are the dividends that appear. Stock issuance, and here's our equity. You can have just a retained earnings statement that shows the opening balance of retained earnings, any income that was recorded to retained earnings or any loss, and then any dividends if you wanted to do it that way. This is just better, just a little bit better disclosure. Here's our balance sheet. Here's a check. We want to make sure our assets equal our liabilities and equity, and they do, right there. Here are our assets. You'll notice, can anybody tell me, you notice anything about the ordering of the assets? Are they in any particular order? Not alphabetical, right? Any guesses? Michael?
Marna is saying liquidity.
Yep.
Current assets come at the end. Several suggestions here.
Yeah, liquidity, exactly. And you'll do the same. You don't really have liquidity of your liabilities, but you'll list your earlier liabilities, you know, and then if you have bonds issued, that would go as long-term liabilities. So you list your current assets first, and then in order of liquidity. If you have investments, that would probably come below the cash if they were liquid investments, right? And we'll use that information when we look at in the next financial statement analysis in the next module. All right, so this was pretty easy. We just pulled this off of our accounts, the big worksheet that I did here with all the balances. That was done for us right there, okay? Then we're just gonna go through with the income statement, and we're gonna look at our revenues and expenses. So here is our, let's see, did we do the income statement? That one's last, right? Oh, let's see, did we do the, I'm sorry, income statement? We did, right? Yeah, that's right, up here. Right. Balance sheet, here's our cash flow statement. So you notice the cash flows broken down. We net all of our operating activities. So wherever you saw an O, add and subtract came out to 11.4. Purchase of rickshaws for our investment activities. By the way, you might be saying, you know, we bought 3 years worth of insurance. Would that be an investment activity? And the answer is no, you're not really investing in the insurance like you are. This is more for longer term liabilities and prepaid expenses like insurance or rent or interest would not be included as an investment. It would be an investing activity. Notice that's a negative 15,000, right? Cash flows from financing. So you can see here the cash increase is 29.4, and that should foot, as we call it, be what we have on our balance sheet, right? Which hopefully we do. Yep, that's another check. What would a bank or somebody look at in a cash flow statement or an investor? A newly formed company typically would have not much in the way of operating cash flow. Investing would be negative, right? Because you're investing. And cash flows from financing would probably be positive. When it's in its prime, it would have operating activities, hopefully in positive cash flow status. May have some investing that might be a little positive or negative, depending on what it's buying and selling. And then the financing typically would be relatively stable unless it was in a growth mode. And when it's wrapping up, operating activities would be going down. Cash flow investing would be turning positive because you'd be selling off your investments. Financing activities would be turning negative. You'd be paying off your liabilities and your investors. By the way, these are prepared typically because you need certain dollar amounts to get to the next statement in a particular order. I, R, B, C. I always tell my students, you can remember this: income statement, retained earnings statement, balance sheet, and cash flow statement by just the simple, very sensible saying, I am ready to be cool, because I've learned accounting. So income, retained earnings, balance sheet, cash flow. So now you've prepared your first set of financial statements. Any questions on the process or general feel for what these statements are conveying? I'll just point this out to you. Look at the income statement down here. The net income is 11,000. Notice the cash flow statement though. Cash inflow was 29.4. Different, right? Because accrual accounting has recognized revenues and expenses that don't correspond to the cash inflows and outflows. And next module, we'll actually do a reconciliation of those differences so you can see, and banks oftentimes want to see that if you have accrual basis to reconcile back to your cash basis and vice versa. I have one last handout that I'll cover, and that's just a little bit more on accruals and deferrals. Okay, and that's this one, which you should have, and I'll give you the, you should have also the answers, I guess, to this. So this is the essence of accrual accounting. The differences here: accruals, notice that within accrual, the income statement is first, statement effect, cash flow second. And with a deferral, you can see that the income statement effect comes after the cash effect. Some examples: Terpsco renders services on account in the amount of 5,000. So we know this one, right? We did this. So we know over here accounts receivable would go up 5,000. We would record service revenue, 5,000. And we'd record retained earnings, 5,000. So again, with the accrual, notice that what's happening is we have an income statement effect first, revenue, right? We're showing revenue. Now we go ahead and receive payment of 5,000. So all that happens is cash goes up 5,000, accounts receivable down 5,000. Income statement effect first, that's a revenue accrual. And we did one of those, right? And we also did an expense accrual. So we've got Terpsco closes its $7,000 two-week payroll, but has not paid its employees. So you're gonna have to show the salaries payable. Goes up 7,000. We're gonna show the salary expense, 7,000. Retained earnings is going to go down, right? 7,000. Now we go ahead and pay the employees. No effect on the income statement. So in one period, you're going ahead and accruing the expense. The next period, you're paying it. All that you're doing is then paying off your payable. Goes down 7, the liability goes down 7. And to balance it off, cash goes down 7, right? So that's accrual. Let's talk about deferrals. We did some of those. Terpsco receives an advance payment of $10,000 for services to be rendered. Cash goes up by 10. Revenue received in advance, a liability, goes up by 10, right? And that's it. Now we have the income statement effect, right? Revenue received in advance, we earn 10,000. So we're going to reduce that by 10. It's no longer a liability. We've paid it off by rendering the services, and retained earnings goes up by 10. Expense deferral. Terpsco purchases a 2-year insurance policy on the lives of its executives for $12,000. Cash, down by 12. Prepaid insurance, up by 12. No effect on the income statement because it's a deferral that comes when 1 year's worth of the insurance has expired. The prepaid insurance goes down by 6. And the insurance expense is now recorded of 6, causing retained earnings to go down by 6. So that really is what accrual accounting is all about, and just kind of a brief overview. So now when you look at a cash flow statement, I was just going to show you in our remaining moments. Let me just stop here for a second and see if there are any questions. I had one more thing I wanted to show you in our remaining moments.
So we don't have any questions at the moment, Eugene. So if you want to go ahead and.
Okay, either everyone's asleep or they got it. So this is off of Apple's 10K, which is an annual report that public companies file with the Securities and Exchange Commission, which I used to work for a few years. So I just want to show you a couple things here. So here's their consolidated statement of operations. Just means that they consolidate multiple companies that are, parent and subsidiary companies. They consolidate them into one financial statement. Notice it's for 3 years. Notice they round here in the millions, right? They round in the millions. It's no different than what we looked at. You can see here they show their sales. Then their cost of sales would be inventory that they sold. Gross margin is simply the difference between your inventory cost and your selling price. So they're giving you an idea of their profitability here. We'll talk about this stuff next week when we look at financial statement analysis. Notice they have their operating expenses here, operating income, the net income right here, and they also disclose their earnings per share. This is something called the statement of comprehensive income. The larger companies get into that. It's a little bit beyond the scope of our course, but if you have questions about that, I'll be happy to let me know. But it's something that we've incorporated in later years, but we're not going to focus on it for our purposes. Consolidated balance sheet. Here are their assets, again, in the millions. So here's a question I wanted to ask you. What is Apple's largest asset? Notice how this balances, by the way, right? Liabilities and equity, and the total assets, non-current assets. What's Apple's largest asset? Anybody know?
Answer is coming in. Brand. I guess people are saying branding, people.
Yeah, very good, very good. That's right. And you don't see that on this balance sheet, do you? That's right. Goodwill would be reflected, any assets that they've purchased. It's probably in their other non-current assets there, but that's very good. And that's one of the issues we're grappling with in accounting, that given the nature of our companies today, they're not showing their most valuable assets. And this is something that we've been dealing with in accounting, trying to maintain our relevance. And I'll just show you lastly, you see the cash flow statement. And here are a series of footnotes that provide additional information about the company. And usually the first note is a summary of their significant accounting policies. And that is basically it.
So Eugene, Daniel has a question, and maybe I'll just let him speak just for fun. All right,
Sure.
Daniel, if you want to ask a question. Oh, I think he's muted right now.
Mm-hmm.
I'll just read off the question. So his question was, for lack of other questions, he's curious, how did you know how so early on that you wanted to be an accountant? And his undergrad class of 09, I guess he took a class from you or something.
I'll tell you a funny story, and this is an absolutely true story, okay? So when I was a young kid, so I'm of age where when I was a young kid, there was one event that shut down the country, okay? And it was the Miss America Beauty Pageant that was held in Atlantic City. And I was about 7 or 8 years old, and I was watching it with my parents. And they were backing me on the couch, and I was lying on the floor. And I was watching it, and I was mesmerized by the talent, the pageantry, and everything. And then right in the middle of it, they said, and now we're going to bring up our accountants, PricewaterhouseCoopers, who are going to verify the balloting process is legitimate, and you can trust who the winner of this pageant is. And I stood up and I turned around to my parents and I said, that's a job for me. And that's an absolutely true story. I thought those guys look pretty cool up there at this event. And over time, I just got to really like it. I really enjoyed accounting. It's like a puzzle. And I think the way you think of the way you process information as an accountant, I think is very interesting. It's a good critical thinking skill. Just learning, walking through something like this, I think is helpful. You know, you'll be surprised. You'll look at things differently. But that's a true story.
Yeah, so with that, I think we're about out of time. So thank you, Eugene, for a very informative first session on accounting. As you can see on this slide, everyone, Eugene will continue with his second webinar and third webinar on accounting in September. So please feel free to sign up. I'll post our kind of link to the Rebooted official page in our chat room. But thank you again for coming. The Maryland Rebooted program is offered by the R.H. Smith School of Business at the University of Maryland, really an effort to help Maryland state residents, particularly small and medium-sized business owners, to navigate this, the economic effects of COVID-19. So we really hope that the webinar series can help you during this difficult time. So thank you so much again for attending, and we'll see you in the next webinar.